Hi, I'm Russ Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Todd Sohn. Todd is a managing director and technical strategist at Strategas. Todd, how are you doing today?
Hey Ross, I'm doing great and nice to speak with you.
Good to talk to you as well. Let's jump right into it. We had, a bit of a choppier April compared to the 5 month run that the major indexes had been on, but we're recovering some of that now. And I guess the question for you is, I'm curious how you all think about these pullbacks in the market. What are you looking for underneath the hood to determine whether it's, a healthy correction or something a bit more serious?
Yeah, Ross, and to give you context, the average year sees about a max drawdown of about 14%. So we hit about 5.5% during the April correction, well short of a historical threshold. I'm not saying that we're going to have to hit that 14% or so level, but just something to keep in mind in case there's further volatility during this election year. The most important clues will come on any resumption of trend higher. We've had a decent oversold response so far, but I get more worried when the market, such as the S&P 500, starts to go on and make new highs, but with less stocks accompanying the new high list. So, for example, from October to March of this year, we had an expanding new high list. That was part of the momentum run we saw for equities. Durable bill markets are built on participation, so you do not want to see the opposite going forward. Credit remains tight. You have high yield spreads below 300 basis points. That's good. And I'm watching consumer staples versus consumer discretionary. Discretionary has paused versus the more defensive staples. That's okay for now, but I would get more concerned if that ratio deteriorates as equities make a move higher. So that's what's on our radar going forward.
Yeah, well, let's hone in on the consumer piece a bit, because we know that this economic cycle and expansion has been built on the idea of a resilient consumer. A lot of consumer spending on the back of stimulus and a strong labor market and reopening from COVID. But consumer discretionary has paused here and looks a bit uncertain. What are you watching in the consumer space to decide whether that trend can continue higher, or whether it's a little bit more worrying under the surface, given how important the consumer and the services and discretionary names have been to the bull market?
Yeah, and so we're aware that big mega cap names like Nike, McDonald's, and Starbucks have deteriorated here. I am curious to see if that moves down the cap scale. You look at some of the small cap restaurants, they've actually been very strong. So perhaps that's reflective of maybe changing consumer preferences or just better pricing power. And I would also keep an eye on what's going on abroad. European automobile names have paused here recently. The luxury good names are trying to get their footholding again, especially as China attempts to reaccelerate. And then the Japanese consumer and auto names had a great run. They got very stretched to the upside. I think those are starting to consolidate. But if all these consolidations start to turn into something more sinister, that's going to be reflected in that consumer discretionary versus consumer staples ratio. And that would suggest that economic deteriorations may start to worsen, especially into the back half of the year. So overall, keep an eye on small cap restaurants, keep an eye on the luxury names and what's going on over in Japan with the automobile industry there too.
Yeah, absolutely. Let's pivot. One of the things that we usually get to talk about with you is some of your work on ETF flows, right? People voting with their dollars. Where is the money headed? Where is it being pulled out from? What does that tell us about sentiment and positioning in the market? You look at this stuff every day. Give me one thing that you're watching or interested in on that front.
Yeah, so broader equity flows for April cooled off about 18 billion. That is meaningfully lower than we've seen over the last few months. I think it's consistent with the shakeout in equities from that month, as well as payments to Uncle Sam related to taxes. But if one thing does stand out, is there's very much aggressive flows to technology-related ETFs, and that's been the right idea. It's been the right call, as the momentum has been for technology and semiconductors. But when the herd starts to get a little bit offsides, I get concerned, and you're starting to see some cracks there in relative performance. On the other hand, when you look at flows to more cyclical sectors such as energy, materials, and industrials, they're roughly negative since the Fed pause last July. So if you're looking for a space where the crowd has not moved on to yet, and there is some leadership and improvements in trend, I would take a look at the more cyclical areas, especially if there's a deeper pullback here into the summer. I assume that's going to present some pretty good buying opportunities, especially if tech has to cool off further, given the huge momentum we've seen from that space.
Yeah, absolutely. If there's one thing I've learned from reading you all, it's good trends, but unloved is a combination that you all like. So we'll keep an eye on that. Todd, thank you as always for the time. It's been really insightful, and we'll hope to get to talk to you again soon.
Likewise. Thanks a lot, Ross.